What we do is we help the advisor, help the client avoid paying any unnecessary taxes. That's what we do. And we do it across the household. It's multi-account. It's tied into risk. So what we're able to do is accumulate the money more rapidly and then quantify the benefit and then withdraw the money, decumulate over time, including, by the way, Social Security is another factor to be considered. So how to maximize retirement income. Guess what? That's what the consumer wants.
All right. Welcome, everybody, to Alternative Universe. This is a show for financial advisors, alternative fund managers, and those who want to navigate the diverse landscape of alternative investments and explore opportunities that lie beyond the conventional. I'm really thrilled to welcome my friend and colleague, Jack Sharry, who's usually on the other side of the mic. He's the host of the well-listened to podcast, Wealth Tech on Deck, an active board participant and committee member of MMI, and Chief Growth Officer at LifeYield. Jack has done so much for so many of us in this industry, and it's really a pleasure to have you on the show and get a chance to hear more about the trends that you're seeing in our industry, Jack.
Great to be here.
Thanks for being here.
Great to be here, my friend.
You know, I was thinking as I was preparing for the show here, you do so much interviewing.
Yes.
On Wealth Tech on Deck. You're often asking the questions and probing these responses. And I don't think many of your listeners have really had an opportunity to hear your background and how you got started in financial services. Why don't we start there?
Great. Well, it's timely. Tomorrow morning, we were talking earlier. Tomorrow morning, I'm heading down to Florida for the MMI meeting called the MMI Summit, which I actually conceived of the idea, I think it was 28 years ago. It was around sales and marketing back then. This time around, I'm participating as an elder statesman, I guess you'd say, with a couple of young folks that are part of a program called Gateway to Leadership, which I'm a mentor in that program, have been for many years, where I work with young folks around how to develop their career. It's, as you know well, Steve, it's one of my passions. I love being a mentor. I teach at Babson College. Just love all that. The panel, it's not quite a panel, it's more of a conversation that I'll be facilitating, is for these younger folks about leadership. How do you do leadership? How do you be a leader? What I've done, I just posted it today, is an article I wrote a couple of years ago. It comes from a book I wrote a few more years ago. So if I were to say the bottom line, it's about authentic and ethical persuasion, but the bottom line of the book is be more interested than interesting. So back to your original question, how did I get started? I got started by answering an ad in the paper. I had no idea what wholesaling was, which is how I got started. I had no idea about sales. I had no idea about, frankly, anything. I'd been a bit of an entrepreneur, not successful, I will add. But I tried my hand at being an entrepreneur around energy conservation. This is back when oil prices were sky high, way back when. Long story short, I didn't know anything, so I developed a skill as a wholesaler, which may be rare, some people who have met a few, where I became more interested than interesting, largely because I didn't know much. And so if I asked a lot of questions, what I found two things. One, I learned a lot. And two, people liked me. They liked telling me what their issues were, their concerns. And over time, and didn't take all that long because you listen enough, you learn a lot in a hurry, which frankly happened. So early in my wholesaling career, I asked a lot of questions. I learned what their pain point was, which was largely, how do I market my practice? How do I build a business? That's really was key. And we're talking a long time ago. This was in the early mid 80s. And so I developed, that's where the book came from. I took a sales class called The Competitive Edge. I think it was 1985. And they talked about listening and the importance of listening. And as you and I have talked plenty, Steve, over time, the more I listen, the more I learn, the better I'm able to discover their pain point, the better I am to provide solutions. So my secret weapon is pretty simple, as I listen. So over time, I was a wholesaler at first of annuities, believe it or not, but I mostly was a seminar giver. I gave seminars, as many as 30 a month. Hundreds of people came out because I helped the advisor. It was essentially a financial planning seminar more than an annuity seminar. And I remember one time in Buffalo, New York, we had 300 people on January 4th, and it was a blizzard. But there they were at the Amherst Marriott. And we did a seminar and gave my little pitch, was financial planning, and 30 advisors were involved in the program. They brought people out because, frankly, those people said, I want whatever that guy talked about. And how did I know what to talk about? Basically, I listened to what the pain point was. And the pain point, particularly the group we were targeting, which were older folks, was retirement income. Things have not changed all that much. And we gave them some solutions, included an annuity, where it wasn't the only answer. It was really about what is it that they felt most comfortable with. Well, over time, fast forward, next step was I became national sales manager at Dean Witter, now Morgan Stanley, for insurance and annuities. By the way, I went from losing my job at the age of 29 because I didn't know how to sell to age 35, where I was the national sales manager for insurance and annuities. So I learned a lot in that time frame. And a lot of what I did was train people. I used to train 100 advisors a month at their training center around listening. So I've been at this listening thing for a while. So did that for a while, went to Putnam, became national sales manager at Putnam, same story. From there, went to what is now Virtus Investment Partners, but back when I was there, it was Phoenix Funds, and then it became Phoenix Investment Partners. And then fast forward to where I am today at LifeYield, same principles apply. Find out what the pain point is. LifeYield, as you all know, Steve, you worked with us closely for many years. What we do is we help the advisor, help the client avoid paying any unnecessary taxes. That's what we do. And we do it across the household. It's multi-account. It's tied into risk. So what we're able to do is accumulate the money more rapidly and then quantify the benefit, and then withdraw the money, decumulate over time, including, by the way, Social Security is another factor to be considered. So how to maximize retirement income. Oh, guess what? That's what the consumer wants. They want to grow their money, the bigger pile of money, as you all know, and they want to take it out, and they hate to pay taxes. And that's what we do. So probably a little more than you needed or wanted, but that's the quick story on what I do. Is I have spent a career listening, and I find the more I listen, the more we all benefit.
I love it, man. No, I mean, it's such a great mentality to bring into the business, because so many of us want to hang our hats on what we know. And, I fall victim to it all the time. It's how we prove our worth. It's how we earn our seat at the table. But
Steve, here's my secret weapon on that. So yeah. Steve and I worked together a number of years, and high degree of regard going both ways. I made sure I always had guys like Steve around who really know what they're talking about. So it worked both ways. I may listen, I may find out what the problem is, and that's the role I've played, continue to play. But then I made sure people like Steve was standing next to me, and then they would explain how to address the problem in a very smart way. So I don't want to minimize that knowing stuff is not important. It is. I just happen to be better on the listening side, and you know how to present it in such a way that it makes too much sense.
Yeah, no, I think it's all important. But something you said when you were telling the story there reminded me when I was just out of college. I read one of the Rich Dad Poor Dad books, the Robert Kiyosaki or whatever. In his book, he talks about someone coming up to him and asking him like, "Hey, I'm on my third book, and I really want to. I don't know how to get distribution, and I'm wondering if you can help me." He goes, "Well, I think you should open the paper and find a sales seminar. They're generally every weekend, and you should sign up for one." And they're like, no, I have a master's degree and I'm working on my PhD and I just want to learn how to sell books. He goes, exactly. And he points to his book and he says, it says New York Times best-selling author, not best writer. It's so true. Sometimes we just walk right past the obvious of what the goal is. And I think in building relationships, and something that you've done masterfully is exactly that. You're good at listening to people and uncovering what the true problem is. And in our industry, I think we walk right past it. We're out there trying to gain AUM and help people, and instead we don't listen to what the consumer wants.
Yep. Frankly, as I mentioned, I teach a class at Babson College. Actually, Steve has joined me for one or two of those classes as a subject matter expert. But when I'm teaching there, a couple of things that sort of stand out. One is, according to the students, what they find most interesting, because they know nothing about selling. It's a course in sales and marketing and leadership, actually, that I'm a guest lecturer. I don't do the whole semester. I just get brought in as a hired gun. But the most popular statement is be more interested than interesting. Another statement that I make in the book is that people are often not listening. They're just waiting for their turn to talk. And so I'm sure we've all been there. I know I find it. And among many other things that we highlight, and I really experienced this during COVID, because I wrote the book during COVID. I'm looking for something to do. The professor who I work with for the past 10 years encouraged me to do so. I tried it out, and because of Zoom and just the way we tend to operate these days, I noticed on that, and this is a tip for those of you who find themselves on Zoom, is to really hone in on what the other is saying. And so because I was writing about listening and talking about it and telling stories about it all in the book, I found that the better I listened, the more effective I was. And frankly, one of my tips, one of my techniques is while people are talking, as I want to interrupt and give them my latest, greatest, bright idea, I just say to myself, shut up, just shut up and listen. And they inevitably tell me more than I would have known to ask, explain at a deeper level what their pain point is. And by the way, I haven't stopped wholesaling. I just happen to call on senior level executives at large national firms and RAs and what have you. So I'm talking to very senior level folks, many of whom were former advisors, and I'm listening for their pain point. I'm trying to make sure I understand what it is that they're trying to solve. And after I hear it, and by the way, because I do this so often, my other big secret advantage or secret weapon is that when I go to give a solution, it's very pinpointed to what they just told me. So when I'm zeroing in on what that solution might be, I'll often say, well, I was talking to Ed Murphy, CEO of Empower, and what he said was, well, if somebody like Ed Murphy says something, I'm going to listen. I mean, he's a pretty smart guy. He's put together an incredible business. There's a validation in that. I'm citing people that are super smart and have been quite effective. So that's also part of it is that what I'm describing here is a practice. It's something I work at literally every day. I have to remember to listen because we have that tendency to want to share our latest brilliant idea.
And, to echo something I've learned from you and something you just said is that it is a practice. For all of us in our careers, regardless of the role, I think it's easy for us to beat ourselves up, especially when we hear something obvious, or it's a practice. So getting an opportunity to just practice and be easy on ourselves and to try and improve is generally how that works. Yep. And something that you've done, over the course of your career. And on that note, you mentioned you came into this industry as a wholesaler responding to an ad in the paper. Man, how things have changed, but not really.
Yes.
In the wholesaling world, when we worked together at LifeYield, we covered, for our team, we covered a large portion of the industry.
Yeah. We've talked to literally everyone in the industry, every firm in the industry, not every person, but every firm for sure. And still have frankly, very good relationships all over. I don't work with everybody, not yet.
It's a good way to approach it. But, I'm curious from your experience how, we can call it wholesaling, but really, what we're talking about is distribution of financial products. And I think sometimes we have our own preconceived notions of what a wholesaler might be selling, whether it's annuities or an investment product, but we're just talking about distribution and how that's changed over the years. I'd love to hear your view on that.
Well, I've been a student of it, that listing thing again. It has changed certainly because when I started, there were brokers and there were products and I guess I can say this out loud. I was at Dean Witter back in the 80s and Intercapital, some listening to this call may remember this, that there was the in-house mutual fund company back when large national warehouses had in-house mutual funds. And they used to be able to incent to sell those. And so every month there was a new mutual fund. And the advisors, after a while, because they would sell it, of course, the NAV would drop right after it, opened, or after it, hit the tape. The advisors started calling whatever came out that month because they didn't quite use whips, but they were trying to get the advisors to sell whatever that was that they were coming out with. And advisors have been burned a few times. So they called them POSSUM, piece of shit of the month. That was the era I started, very product oriented. Well, fast forward 40 years later, 40 years later, really. And the big shift that I see underway is the shift toward solutions. That's more words than deeds oftentimes, but it's really about the combination of equities, ETFs, it's alternatives, annuities. There's lots of different ways to put it together. So it's moving toward a solutions orientation. And I have a particular bias because of what LifeYield does. We do that. We do it from a tax optimization kind of overlay kind of basis. But the whole idea is how do I put it together and how do I help the investor? Two key things. How do I have the experience be intuitive, graphic, understandable? How do I do that? Which we're still, frankly, have a ways to go. It's better, but much more to go in my view. And how do I improve outcome? And as you know, Steve, to the degree you can quantify the benefit, makes it all the more real. So there are a couple of things that we work on every day at LifeYield is how do I create a better user experience, both for the investor and the advisor? And how do I quantify the benefit in dollars and cents and basis points? So our industry is moving that way, and they're moving toward a multi-account, household level portfolio management schema. And for those who have not paid close attention to how that all works, if you're going to improve outcome, which is critical in my view, it's what people are looking for, especially as markets get choppy. I know we're in another one of those bubbles where the trees go to the sky. But it's all around managing cost, risk, tax, and Social Security. Those are the levers to improve outcome. And so increasingly, and we're working on all of the above, increasingly as you integrate all these elements together, you will not only have a better experience if that's done well, and that needs some more work as our industry grows and continues, but also then you have to factor in cost and risk and tax and Social Security. So there's a lot of movement there, a lot more to go, frankly. And frankly, if you're really going to strip it all down, if you do risk, tax, and Social Security, you don't have to worry so much about cost because you can demonstrate value. So cost, in the absence, as Don Connolly, it was a Putnam with me way back when, what Connolly used to say is cost is an issue in the absence of value. And it's so true. And so our industry, asking where it's going, Steve, it's going in that direction. A lot more to go. Lots of stuff that we're working on are pretty exciting. You'll be seeing about it now, but we're making that available and doing that at firms across the industry. And it is a lot of fun.
I now focus on the private markets, under the umbrella we all know as alternative investments.
Sure.
And, I'd say when I kind of lay out my career path, it's working with LifeYield and focusing on tax efficiency and speaking with advisors about wholesaling naturally led me to this fragmented, completely disjointed asset class.
Yep.
Where it's just not included.
Yeah.
A lot of the time it's just totally treated as separate from the investments that an advisor is managing. And a lot of investors want it. And so as it's disconnected from their household and how the portfolio is being managed and talked about and reported on, clients go do it on their own.
Yep.
And we all know that does not tend to equal better outcomes.
Yep.
We need a quarterback calling plays. And so this idea of householding and coordinating things together to reduce taxes, but there's a lot of opportunity to create efficiency there, not just for the investor, but also for the advisor.
The biggest single cost an investor incurs over the course of their lifetime are taxes, more than healthcare, more than anything else you might come up with. So it's taxes. So if you can manage taxes and minimize taxes, and as you know, Steve, we did, EY did a study on our methodology. We improve outcome by 33%. So it's no small number. And then the other factor, of course, is risk. And you got to manage risk consistent with what people's objectives are, where they feel comfortable. And alternatives certainly plays an important role there. But also the taxes play an important role because it's not what you make, it's what you keep, as you well know. So the industry, and my prediction, I know it's coming, is alternatives and taxes, or risk and taxes are getting married up as we speak. Lots of firms working on this. And that helps you not only have a risk-adjusted return portfolio that you can be comfortable across multiple accounts, qualified, non-qualified, the whole 9 yards. Then when it comes to income, then how do I make that withdrawal in a tax-efficient manner? And so the industry is making great progress, a lot more to go. But I know you're working on it, we're working on it, a few other folks working on it. The whole idea is let's improve outcome for the client. We frankly don't have to worry as much about cost because we're bringing real value to what we're talking about. And just for fun, we'll throw in Social Security because it's free money if you manage it right. Just client's better off. They love you for it. They ask you what to do their rollovers after you do it for them. Hallelujah. It's a win-win all around.
Yeah, 100%. It was a conversation we would have with advisors all the time. And a lot of them would, again, I think it was something where they didn't necessarily see a paycheck directly tied to helping someone file for Social Security. Yep. And so it became an afterthought. And I would hear it all the time. On my clients, I work with ultra high net worth, and they just wait until 70 every time or whatever, some weird rule of thumb.
Yeah.
And when you challenged them on it, it was, and you help them optimize that strategy for the client. They'd uncover 50 grand, 100 grand, 200 grand.
Well, I'll give you a number.
And
One of the largest wirehouses, household name, our Social Security tool is embedded. You won't see our name because it's they use the firm's name and another moniker to describe it. It's used by 90% of the advisors. And on average, last year, we saved each client, or we found money in terms of Social Security benefits of $191,000. I've yet to meet anyone that didn't want to find $191,000. They all do. It may come as a shock, but they all appreciate that. More importantly, what they ask after this is discovered, one, they love the advisor. The conversation around fees quiets down quite a bit in terms of any concern they might have because you found money for them. All by itself, everything I just said was why this particular firm's advisors love us so much. What we found out really was that the next question after you show them that level of savings or found money really is what it is, they would say, what should I do with my rollovers? For many advisors I know, Their strategy is hope. They hope the rollover falls in their lap. That's kind of I don't mean to be critical, but there's not much of a strategy because how do you differentiate? You get better service, you're a better investment advisor. I don't know. None of those hold a lot of water. Maybe they're appreciated, but if you can show them, because by the way, everything I just said is quantified. Here's $191,000 more. What can you do for my rollover? Yeah, that sounds good. Let's do it again. So more is coming on that front about really demonstrating value over time. And as an industry, we're just getting better at it. And ultimately, frankly, when the household is managed as a household, the client's going to do better. They're going to have more money after tax and consistent with their risk comfort.
On the topic of householding, I know you speak with a lot of different firms across the industry. A lot of the time I tend to focus on wealth management, RIAs, and the independent space. But as you mentioned, you guys work with wirehouses and broker dealers and RIAs. If you were looking out at the next 5 to 10 years and had to call out some trends, where do you see our industry going? What big changes do you see happening in our industry that people should be on the lookout for?
The future is all about multi-account, tax-smart management for accumulation and withdrawal. When I say tax-smart all the way up, all the way down. And as I mentioned, the EY study, at least in terms of our methodology, improves outcome by a third. I've met too many people that can, any advisor can say, I can improve your results by a third. It's just not possible. And no knock on anyone, it's just not possible. But by rooting out the inefficiency, as you've said for many years, Steve, as avoiding unnecessary taxes, that's all we're talking about. So the trend, in my view, and I write about this for FA Magazine, I have a monthly column, I do a podcast, as you mentioned earlier, we talk about this all the time. The future is about platforms. The future is about ecosystems, and not just a series of disconnected elements of an ecosystem or tech stack. It's a coordinated, interoperable, and that system, and that is no small feat. So certainly something we work on. And the industry is very much moving in that direction. And there's also some interesting things happening around this whole topic, around doing it at a sub-advisory level. Stay tuned on that. We're not ready to announce anything, but it's coming, where you can do it, where you can incorporate tax alpha benefits into a portfolio management. The advisor still runs the portfolio, but you just take advantage of the tax alpha. So stay tuned. That's on its way. So that's my prediction. This is where we're going. And it's all about improving outcome and improving the experience.
From my focus here, when I look at and speak with both fund managers and advisors interested in allocating to private investments, as mentioned earlier, they're kind of treated separately. And I would just raise the flag here that if we're interested in this asset class, one of the big things that comes up is liquidity. And I can generally address those liquidity concerns with a client and make an appropriate recommendation if I'm considering the entirety of the household, all the other assets, both public and private, as one, and plan for it. And we need systems like you're describing, Jack, that LifeYield's been developing and has developed and implemented so that I can plan for liquidity concerns, risk, cost, right? Again, it's all only an issue in the absence of value, but I need to be able to demonstrate it. So bravo to LifeYield. I think that, the time that I spent working with you, being able to quantify that number it was a game changer. I'll never forget a meeting I had with an advisor. We took them through a demo. We would often do this. We'd ask them to send us one of their portfolios, strip the client name, send us a portfolio, all the holdings, the account types, little bit more information about people from their planning conversations. But we would run an analysis and we'd show them, hey, this is how much you can improve the outcome for this client. 15 basis points, 25, 50 basis points sometimes, or more. This advisor's like, man, I can't unknow this.
It's true.
I can't unknow this. Now I know that there's some inefficiency out there, and I feel compelled I have to go fix it for my clients.
So true. It's so true.
Well, Jack, if there's anything that you want to leave our audience with, I'd love to hear maybe a couple of takeaways.
Another prediction, something that's a story I'm developing as part of, I'm a storyteller, as you may have observed. The story I've been running with, let me try it out on you, Stephen, and audience. We are fortunate enough to attend the Tiburon Summit. There's one coming up in a couple weeks in Boston. Twice a year, Chip Rome runs. It's a bunch of folks from across the industry, senior level execs, talking about the future of advice. And one of the things he said at the most recent Tiburon is that, and he and I had a conversation on this recently, if you strip away acquisitions and you strip away markets, you wouldn't buy it as a growth stock. Our industry, financial services, it's 3 to 4% growth on average. And frankly, 2 years ago, I think it was 2.4%. The year before it was 6.2%, but it dropped. And a lot of this has to do with markets, basically, in terms of the sort of the net flows is really what sort of the measurement that's being looked at. So we're not a growth industry. And the reason we're not a growth industry is that, frankly, markets have gone up for 40 years. And so you always have more money. So how brilliant are we just because we wound up the right kind of business? Where I see our industry going is, how do you create organic growth? How do you grow your practice really? How do you get better valuation for your business? I think that's the game. And I know that's one of the things that we're working on. How can we help advisors and their clients have more money? And a lot of it comes from a few different places. One is by asset retention. So if you pay less in taxes, you keep more money. We do a lot of work with major national firms. Their CFOs love us because in April, they watch a lot of money flow out of those firms to go pay taxes. So if you can retain assets, you're in a better spot, whatever the size of your practice. And if you can minimize taxes as you're accumulating, and all this we can quantify, you're going to have more money. You're retaining and you're adding. You're going to have more money. You're going to have a bigger pile of money. The only way you achieve that is through asset consolidation. Oh, that's another benefit. If you're running a business, you are giving cause to consolidate assets because you've demonstrated that you can manage in a tax efficient way. Still, however you run money, whatever your style is, I'm leaving that out because if you're good, bad, or otherwise, it doesn't matter. But if you can handle the tax thing, both on a retention basis and at an accumulation level, you're better off. And then when it comes time to draw income, how do I do so in a tax efficient way? As we all know, because of qualified, non-qualified accounts, it's inherently inefficient, just sort of built that way. The industry wasn't built to be efficient. That's all changing. It's taking a lot longer than any of us would like. But my final thought is, be on the lookout, be ready to deal with taxes, to deal with risk. And frankly, in the alternative space, that combination is golden because you can not only manage your risk, but you can also manage your tax. When you do that, your clients will have more money. You'll have more money. Hallelujah, we all win.
Love it. Well, Jack, you're doing awesome work, man.
Thanks. It's fun.
It's been a pleasure to work with you. And I've really enjoyed having you on the show today.
My pleasure.
We'll add some links there in the show notes so people can go check out LifeYield and your podcast. Yeah. And everybody, thanks so much for listening to this episode of Alternative Universe. This podcast is brought to you by Mammoth Technology and produced by Turncast. If you like the show, consider sharing it with a friend. You can subscribe where you're listening to this podcast right now. For more information about Mammoth Technology and Alternative Universe, please visit mammothtechnology.com. Everything discussed on this podcast is for informational purposes only and should not be considered advice. The participants may have financial interests in the companies discussed on the podcast.